The causes and consequences of the recent failures of Silicon Valley Bank, Signature Bank, and other regional banks that have triggered a banking crisis and a credit crunch. In March 2023, the U.S. banking system faced a major shock when two of the largest regional banks, Silicon Valley Bank, SVB, and Signature Bank, collapsed within days of each other. These failures were followed by a wave of panic and uncertainty that threatened the stability of the financial system and the economy. But what caused these banks to fail so suddenly and spectacularly? And what were the implications for their customers, investors, and the broader society? Silicon Valley Bank was the 16th largest bank in the U.S., with assets of about $209 billion. It was known for serving startups and venture-backed firms, especially in the technology and healthcare sectors. According to its website, 44% of the venture-backed IPOs in 2022 were clients of SVB. Signature Bank was the 29th largest bank in the U.S., with assets of $110 billion. It was one of the few banks that accepted crypto deposits and became a leader in cryptocurrency lending. It also served middle-market businesses and high-net-worth individuals. Both banks had several factors in common that contributed to their downfall. These include poor management. According to reports by the FDIC and the Federal Reserve, both banks failed to implement adequate risk management practices and ignored warnings from regulators. They pursued rapid and unrestrained growth without considering the potential consequences. They also did not diversify their sources of funding and relied heavily on uninsured deposits. Crypto exposure. Both banks were heavily involved in the crypto industry, which exposed them to high volatility and regulatory uncertainty. When interest rates started to rise and crypto prices started to fall, many crypto depositors withdrew their funds from the banks, creating a liquidity crunch. The banks also faced losses from their crypto lending activities, as some borrowers defaulted or became insolvent. Contagion effects. The failure of SVB triggered a domino effect that spread to other regional banks, especially those with similar business models or customer bases. Signature Bank was one of them. After SVB collapsed, Signature Bank's shares plunged by 25% in one day, prompting a run on deposits by customers who feared losing their money. The bank was unable to meet its obligations and was shut down by regulators. The consequences of these failures were severe and far-reaching. They included losses for depositors. Although the FDIC guaranteed all deposits up to $250,000 per account, many depositors had balances above that limit and faced losses. Some depositors also faced delays in accessing their funds or transferring them to other banks. The FDIC estimated that it would cost $15.8 billion to cover the insured deposits of both banks. Losses for investors. The shareholders of both banks lost all their equity value when the banks were closed. The bondholders and other creditors also faced losses or haircuts on their claims. The FDIC announced a special assessment on large banks to recoup some of the costs from the insurance fund. Losses for borrowers. Many borrowers who relied on SVB or Signature Bank for financing faced difficulties in finding alternative sources of credit or refinancing their loans. Some borrowers also faced higher interest rates or stricter terms from other lenders who perceived them as riskier. Losses for the economy. The failures of SVB and Signature Bank eroded confidence in the banking system and caused a credit crunch that affected many businesses and consumers. The reduced availability and increased cost of credit hampered economic activity and growth. The failures also raised questions about the adequacy of regulation and supervision of regional banks and the crypto industry. The failures of SVB and Signature Bank were unprecedented in scale and impact since the global financial crisis of 2008. They exposed the vulnerabilities and risks inherent in the banking system and highlighted the need for more vigilance and prudence from both bankers and regulators. U.S. regional banks are facing a paradox of decline in a challenging and uncertain environment. On one hand, they are struggling to maintain profitability and competitiveness in a low-interest rate regime, where their net interest margins are squeezed and their loan growth is sluggish. On the other hand, they are exposed to various risks and pressures that could threaten their stability and solvency, such as asset-liability mismatches, deposit outflows, credit quality deterioration, and bond market volatility. One of the main challenges for regional banks is to manage their asset-liability structure in a way that balances liquidity and profitability. Regional banks typically rely on deposits as their main source of funding, but deposits are not stable or loyal. They can easily move to other banks or financial products that offer higher returns or better services. Moreover, deposits are often short-term and demandable, while loans are long-term and illiquid. This creates a mismatch between the maturity and interest rate sensitivity of assets and liabilities, which can expose regional banks to interest rate risk and liquidity risk. Another challenge for regional banks is to maintain their deposit base in the face of fierce competition from larger banks and non-bank financial institutions. Larger banks have more diversified business lines, more access to capital markets, and more economies of scale and scope. They can offer more attractive rates, fees, products, and services to depositors, as well as leverage their brand recognition and reputation. Non-bank financial institutions, such as fintech companies, money market funds, and online platforms, also pose a threat to regional banks by offering alternative and innovative ways of saving and investing money. These competitors can erode the market share and customer loyalty of regional banks, forcing them to lower their deposit rates or increase their marketing costs. A third challenge for regional banks is to ensure their credit quality and loan performance in a changing economic landscape. Regional banks are often concentrated in certain geographic areas or industry sectors, which makes them vulnerable to local or sector-specific shocks. For example, regional banks that lend heavily to energy, agriculture, or commercial real estate sectors may face higher loan losses if these sectors suffer from low commodity prices, trade disputes, or pandemic-related disruptions. Furthermore, regional banks may face higher default risks as interest rates rise and borrowers face higher debt service costs. A fourth challenge for regional banks is to navigate the bond market fluctuations and uncertainties. Regional banks often invest a significant portion of their assets in bonds, such as treasury securities, municipal bonds, or mortgage-backed securities. These bonds provide income and liquidity for regional banks, but they also expose them to market risk and reinvestment risk. Market risk refers to the possibility that bond prices may decline due to changes in interest rates or credit spreads. Reinvestment risk refers to the possibility that bond proceeds may have to be reinvested at lower rates than the original bonds. Both risks can reduce the income and value of regional banks' bond portfolios. In summary, regional banks are trapped in a paradox of decline where they face multiple challenges and pressures that undermine their profitability, asset liability management, deposit stability, and bond investments. These challenges and pressures are likely to persist or intensify as interest rates rise, credit conditions tighten, competition intensifies, and economic uncertainties remain.